If you are new to trading, you may hear people say the market seems bearish, and you wonder, are we selling bears? What does a bear have to do with trading? Before you call animal control, it's not actually a living bear. It's just a term or a slang for buyers and sellers in the market. Today, I'm going to share with you all the trading slangs so you don't get confused anymore. Without further ado,
Let us begin!
so bears. Bears are the sellers in the stock market. Bear market generally refers to a weakening economy or a downtrend. Generally, when we say that the market is bearish, it has declined more than 20%. Likewise, bulls are the buyers in the stock market. A bullish market means that the company is doing well and the prices of the stocks are rising. When we say a bullish market, it means that the market has gone up more than 20%. Next up is going long or a short position. Going long means buying a position so you make profits when the stock price increases. And going short means you sell the position first before buying. In this scenario, you make profits when the price decreases. Another term you may hear often in article and news is cold and hot stocks. So cold stocks are the ones that is trending down or declining in price and trades, and a hot stocks are the one that is trending up or increasing in price and trades. Now that's out of the way, let's talk about future trades or option trading. Future trades or future contract is a legally binding agreement between buyers and sellers to trade at a predetermined price on a specific date. That's confusing, right? So let's try an example. Let's say you buy a future contract for 100 shares of stock A at rupees 100 per share with an expiration date at 30. You are now required to buy that share at rupees 100 even if the share price has risen to rupees 110 per share. By the end of the expiration date, you have to buy it at rupees 100 and you can make a profit. This logic also applies in selling. Now let's move on to option trading. Option trading is also similar to future trades, but in this contract, you have a choice to cancel the trades. So basically, option trading or an option contract gives you a choice, not a requirement, but a choice to buy or sell an asset at a specific price within a set time frame. If that's confusing, let me give you an example. Suppose you purchase a option contract for a share of stock A at a strike price or a predetermined price of rupees 100 with an expiration date of 3 months. If the stock price has risen above rupees 100 within that 3 months, you can now exercise the option and buy the share at the predetermined stock price, that is rupees 100, and make some profits. However, if the stock price goes below the strike price, you have a choice to not exercise that contract, limiting your losses to only the service charges. Well, that's about it for this video. If you have any questions you would like me to answer, comment down below, or for more private questions, message me on Instagram. Love ya, bye.